So if a single factory complex in the Netherlands somehow, I don't know, just lost power tomorrow.
Right, just completely went dark.
Yeah, and they couldn't get it back online, the entire global artificial intelligence arms race would it would just grind to an absolute halt within months.
Oh, absolutely. Everything would freeze.
Like every major tech giant, every smartphone manufacturer, defense contractors, they would all eventually hit a brick wall. So today, we aren't just looking at, a successful tech company.
No, not at all.
We are looking at what is arguably the single most critical bottleneck in the entire 21st century global digital economy. So welcome to this deep dive. I am incredibly excited to have you listening today as we explore the absolute phenomenon that is ASML holding.
It really is the ultimate bottleneck. Like when you look at the architecture of the modern world, all roads eventually funnel through their machines.
Yeah.
And the data we have today paints a picture of a monopoly that's so dominant it almost defies standard economic gravity.
It really does. And for you listening right now, the stack of sources we're working from today is incredibly comprehensive. We are digging into an exhaustive strategic equity research report, and we're pairing that with the latest AI-generated deep value intelligence report on ASML.
Which is dated today, right?
Yes, exactly. Dated today, April 15th, 2026. And the mission for our deep dive today is to unpack this really fascinating and frankly, kind of bizarre paradox.
It is a bit of a brain breaker.
It is. How does a company with an unassailable monopoly and genuinely perfect business fundamentals completely terrify traditional value investors?
Okay, let's unpack this.
Well, to understand the fear, I think we first have to understand the sheer unprecedented scale of their success.
Right.
Because before we even touch the stock price or the multiple or any of the valuation models,
We have to look at the actual business.
exactly, we have to establish the physical reality of what ASML actually does and why they're currently swimming in just an absolute ocean of cash. Because they really are. I mean, I'm looking at their Q1 2026 earnings here, and they are pulling in massive amounts of revenue, like billions in net sales.
Oh, yeah, massive numbers.
But what jumps out at me isn't just the sheer volume of cash coming in. It's the underlying machinery of how they make it. The gross margins are sitting at an exceptional 53.0%.
Which is wild.
It's absurd. For a company that manufactures giant physical hardware, that's software-level margins.
It is. They reported 8.8 billion euros in total net sales, comfortably hitting the upper echelon of their own guidance.
Wow.
But you pointed out the margins. And a huge driver of that 53.0% is a massive surge, about 16.6% in what they call their installed base management segment.
Okay, wait. Installed base management.
Yeah.
That sounds like serious corporate speak for we fix things. What is the actual mechanism there? Why is that so lucrative for them?
So think of an ASML lithography machine a bit like a commercial jet engine. When an airline buys a jet engine, they don't just pay for the metal and say goodbye, right?
Yeah.
They sign a decades-long service contract.
Right. For maintenance and parts?
Exactly. The manufacturer monitors it, they update the software, replace parts, and basically optimizes performance continuously. And ASML does the exact same thing.
Oh, I see.
Once a customer like TSMC or Intel buys a machine, they are locked into this highly lucrative ongoing service ecosystem. The software upgrades alone are basically pure profit for ASML.
Which proves their moat isn't just, selling a box. It's an ongoing, deeply integrated partnership.
100%.
But maintaining that edge isn't cheap. The research report notes that their R&D spending is just astronomical. They spent 4.7 billion euros just on research and development.
And that was a 9.2% surge, by the way.
Right. You don't spend nearly $5 billion just tweaking a completed product. What are they actually building that costs that much money to figure out?
They are quite literally trying to bend the laws of physics.
Okay, explain that.
That R&D budget is largely driven by the rollout of their cutting-edge high-NA EXE 0.52 Euro-B systems to early adopters.
INA?
Yeah, NA stands for numerical aperture. They're constantly trying to focus light more sharply to draw smaller and smaller transistors.
Let's make that visual for everyone listening, because trying to understand extreme ultraviolet or EUV lithography is tough.
It's basically magic.
It is. The best way I can describe it is this. Imagine trying to paint a perfect replica of the Mona Lisa.
Okay.
Now imagine you have to paint it using a paintbrush that is smaller than a single atom.
Right.
And you have to paint millions of them flawlessly in a matter of seconds. That is essentially what these machines do. They use highly engineered light to print nanometer-scale integrated circuits onto silicon wafers.
And it gets crazier, because the light they use is so incredibly fragile that it gets absorbed by air.
Seriously, by just normal air.
Yes. So all this has to happen in a total vacuum inside the machine.
That's insane.
And to guide that light, you can't use regular glass lenses. You have to use mirrors.
Mm-hmm.
But not just any mirrors.
Right. The report mentions Zeiss.
Exactly.
Mm-hmm.
They rely on a deeply integrated, decades-long partnership with a German company called Zeiss to make these optical mirrors.
Yeah.
And to give you a sense of the engineering involved here, these mirrors are polished to be so incredibly smooth that if you were to scale one of these mirrors up to be the exact size of the Earth,
The size of the entire Earth. Okay.
the tallest mountain or the deepest valley on its surface would be less than a single millimeter high.
Wow. That is just staggering. But look, I've covered enough tech booms to know there is no such thing as an invincible business, right?
Sure.
The semiconductor industry is famously volatile. It's incredibly cyclical. You have boom years where everyone buys a new phone and bust years where warehouses are just full of unsold chips.
Absolutely.
So if the semiconductor industry is known for being volatile and cyclical, how is ASML immune enough to pull in these kinds of numbers consistently? What happens when TSMC stops building new factories next year?
What's fascinating here is that crucial distinction. ASML is not just riding a consumer product cycle.
Okay.
They are the toll booth of the AI infrastructure supercycle.
The toll booth.
Yes. Think about the arms race happening right now between TSMC, Intel, and Samsung. They are battling for absolute supremacy, trying to build smaller, faster, more power-efficient AI chips.
Right. For companies like NVIDIA and Apple.
Exactly. And to do that, to physically manufacture, say, a 2-nanometer chip, they have absolutely no choice but to buy ASML's machines. There's no alternate route.
Wow.
ASML literally dictates the pace of Moore's law.
So even in a down market, if Intel wants to leapfrog TSMC, they have to pay the toll. They can't just pause their technological roadmap because consumer demand for laptops is soft this quarter.
Precisely. The semiconductor inventory cycle might fluctuate, sure, but the technological roadmap relies entirely on ASML delivering their next-generation high-NA systems.
Got it.
The industry fundamentally cannot advance without them. If you want to play in the AI era, you buy from ASML or you exit the business.
Okay, but wait. Capitalism dictates that if a company has 53% profit margins, someone should swoop in and undercut them.
You would think so.
Right, like a tech giant with hundreds of billions in cash like Apple or a sovereign wealth fund could look at that and say, let's build our own machine for half the price.
Yeah.
Why hasn't that happened? How does a 100% monopoly actually exist in 2026? I mean, there is no Pepsi to their Coca-Cola.
Because the barrier to entry isn't just financial capital. You can't just throw $20 billion at a wall and expect an EUV machine to pop out.
Right.
The barrier is physical, and more importantly, it's historical. We mentioned the Zeiss mirrors earlier. That partnership wasn't formed yesterday.
Right. It's decades old.
It represents decades of shared institutional knowledge, trial and error, and completely proprietary supply chains. I mean, an EUV machine contains around 100,000 distinct components.
100,000.
Sourced from a highly specialized, exclusive global supply chain. You simply cannot replicate 30 years of embedded, compounding engineering knowledge overnight. You can buy engineers, but you cannot buy time.
Which completely explains their absolute, unadulterated pricing power. I mean, the report states that current EUV systems cost roughly $150 million each.
Yeah.
And those next-generation high-NA machines we talked about, those exceed $350 million per machine.
It's unbelievable.
And the executives at ASML know exactly what they're sitting on. The alignment between management and shareholders is incredibly strong.
Very strong.
CEO Christophe Fouquet's compensation is heavily weighted in long-term equity. He makes about 7.02 million euros, but the real wealth comes from executing their 2030 targets.
And we're seeing active, massive insider buying, which is always, a great signal.
Always.
The CFO, Roger Dassin, made a multi-million euro open market acquisition of 4,370 shares recently. When the chief financial officer is taking his own cash and buying the stock on the open market, it tells you a lot about their internal confidence.
So let's run this through a traditional quality filter. How does this stack up if we look at it through the lens of someone like Warren Buffett?
Well, through a pure business quality lens, it is a masterpiece. It easily passes Buffett's moat test and management quality test.
Okay.
The Deep Value Intelligence report actually scores it an 8 out of 9 on the Piotrowski F-score.
Okay, for the listener who might not spend their weekends reading financial textbooks, what exactly is the Piotrowski F-score measuring here?
Good question. So Joseph Piotrowski was an accounting professor who created a 9-point scale to measure the absolute fundamental strength of a company's financial position.
Right.
It looks deeply at profitability, leverage, liquidity, and operating efficiency.
Okay.
Scoring an 8 out of 9 means ASML isn't using accounting tricks or taking on dangerous debt to look good. They're genuinely generating massive, clean cash flow.
That's incredible.
They boast a return on equity consistently hovering near 49 to 50% and a return on invested capital above 60%.
60%. So for every dollar they pour back into the business, they're generating 60 cents in operating profit.
Exactly.
In the industrial and manufacturing space where you have to build giant physical factories, those numbers are almost unheard of.
Truly rare.
It shows a company taking that massive 4.7 billion euro R&D budget and turning it into extraordinary compounding value.
Absolutely. It is the definition of a capital-efficient monopoly.
But here's where it gets really interesting, because everything we have discussed for the last 10 minutes paints the picture of a flawless business.
Yeah, a perfect machine.
Perfect moat, absolute pricing power, visionary management, pristine balance sheet. And yet, the AI multi-agent system from our sources gives ASML a final investment stance of watch. Not advocate, not buy. It says watch.
Yeah.
Why?
This raises an important question, maybe the most important question in all of investing. What is the price of perfection? Because right now, the math surrounding ASML's valuation presents a profound, deep value paradox. You can have the greatest business on earth, but if you pay the wrong price for it, it can still be a terrible investment.
Okay, let's get into the hard numbers, because this is where the tension lies. As of today, April 15th, 2026, ASML is trading at roughly $1,482 per share.
Right.
Their price to earnings, or PE ratio, is hovering around 50x to 51x. For context, the traditional Benjamin Graham deep value benchmark, the absolute gold standard for value investing, demands a PE under 15x.
Yeah.
So ASML is more than 3 times more expensive than a classic value stock.
And it goes much deeper than just earnings, too. Look at the price-to-book ratio. It stands at an astronomical 24.9x. Traditional value investors look for a price-to-book of 1.5x or lower.
Explain the mechanism behind that for us. What does a price-to-book ratio of nearly 25 actually tell you about what you're buying?
So book value is essentially the net asset value of a company. If you liquidated ASML today, sold all the desks, the buildings, the physical cash in the bank, and paid off the debts, that's the book value.
Right. The tangible stuff.
Exactly. A ratio of 24.9x means you are paying nearly $25 for every $1 of actual physical assets.
Oh.
Now, part of this massive discrepancy is because ASML's true value, their institutional physics knowledge, their patents, their ecosystem lock-in, none of that is capitalized on their balance sheet.
Because you can't put a line item on an accounting ledger for holds a monopoly on the future of global computing.
Exactly. So the book value looks artificially small.
But even if we ignore book value and just look at the cash they generate, the intrinsic value estimates from the report really highlight the danger zone we are in here.
Oh, definitely.
If you use the strict Buffett method, calculating owner earnings, the average intrinsic value comes out to just $563 a share.
Yeah.
And even if you use a more forgiving cash flow method, the average intrinsic value is $907. Both of those are massively below the current $1,482 trading price.
And that is exactly why it completely fails orthodox Benjamin Graham-style value screening. In value investing, the core tenet is the margin of safety. The idea is that you buy a dollar for 60 cents. That way, if your assumptions are slightly wrong or the economy takes a hit, you have cushion. You are protected.
But here,
with ASML trading at nearly $1,500, there is absolutely zero margin of safety. You're paying a massive premium, exposing yourself almost entirely to multiple contraction risk if the semiconductor cycle slows down even slightly.
let's break down multiple contraction for you listening, because it is the silent killer of great portfolios.
It really is.
Multiple contraction is when the business continues to do exceptionally well. They make the exact same amount of money or even grow, but the stock market broadly decides it is no longer willing to pay a massive premium for that growth.
Yes.
So ASML could execute their strategy perfectly, but if the market decides a 50x PE is too rich and adjusts it to a 30x PE, your stock price plummets, even though the business succeeded. So you're paying for the year 2035 success today. You aren't betting on if the business is good. We know it's incredible. You're betting on if reality can possibly match the market's wildest dreams.
Exactly. If AI capital expenditure from companies like Microsoft or Meta takes breather for even 2 quarters, ASML, the business, will be perfectly fine, but ASML, the stock, could compress violently.
Which brings us to the real world. because the data is so polarizing, it is causing a massive divergence in how professional heavyweight investors are handling the stock right now.
Yeah, a tale of two investing styles, really.
Exactly. The sources give us a brilliant breakdown of this playing out in real time. It's fascinating to see billionaires look at the exact same data and come to completely opposite conclusions.
Let's start with the bearish, or at least the highly cautious side. You have Peter Thiel's investment vehicles.
Okay.
They looked at this exact setup and completely exited their position in Q2 2025. They sold 68,435 shares at an average of about $662.63.
Wait, why did they sell so early? Because the stock ended up doubling into 2026. Did they just get the math wrong?
No, it wasn't about getting the math wrong. It was about risk-reward skew and opportunity cost. Thiel's team likely modeled out the cash flows and determined that the easy money had been made.
Ah, I see.
The upside was capped by the valuation, while the downside risk of a semiconductor slowdown was growing. So they locked in their gains before the stock doubled, adhering to a strict discipline that says, we don't pay for perfection. They decided to watch from the sidelines.
But then you have the complete opposite philosophy. Fisher Investments, acting on a long-term growth and quality mandate, actively acquired stock through 2025 and 2026.
Right.
They added 108,000 shares. They now hold 4.4 million shares, worth nearly $5.9 billion. And WCM Investment Management aggressively increased their stake too by nearly 25%. Why are they aggressively buying what Thiel decided was too expensive?
Because they operate on a JARP philosophy growth at a reasonable price.
XRP, okay.
Yeah, popularized by Peter Lynch. This philosophy argues that a 50x PE ratio is actually cheap if the underlying growth rate of the business is exponential and highly secure. They are looking at the secular AI supercycle. They believe that the transition to an AI-driven global economy is so massive and ASML's monopoly so unbreakable that in 10 years, we will look back at a $1,500 stock price and think it was a bargain.
So they are entirely ignoring the short-term cyclical risks to capture the decade-long compounding.
Exactly.
And right in the middle, you have massive institutions like T. Rowe Price. The report notes they trimmed their positions by roughly 38% to rebalance as the price breached $1,400.
Yeah.
So they aren't abandoning ship like Thiel, but they aren't loading up like Fisher. They are executing prudent portfolio management. When a stock runs up that high, it becomes too large a percentage of a mutual fund's total assets, so they are forced to take chips off the table to maintain balance.
The intelligence report synthesizes all of this perfectly by framing the stock through two distinct lenses.
Okay.
Through a Peter Lynch JARP lens, ASML is an absolute advocate. It's a fast grower with a huge moat, riding a secular AI wave that could push them to a $2 to $3 trillion valuation by 2035.
Wow. 2 to 3 trillion.
But if you view it through a strict Buffett value lens, demanding a margin of safety and capitalization of current assets, it is a definitive watch.
So what does this all mean for you? Ultimately, your stance on ASML depends entirely on your own investing philosophy and your timeline. Are you a growth investor, willing to pay a premium for a monopoly because you believe they enable the entire future of technology? Or are you a disciplined value investor, waiting patiently for a semiconductor downturn to offer a better entry price?
It really is the ultimate test of investor discipline. The business is a marvel, but the valuation is a tightrope.
To summarize everything we've unpacked today, ASML is the undisputed king of tech hardware. They have a near unassailable monopoly, spectacular margins, and a customer base that literally cannot physically build the future of AI without them. But it is currently priced for absolute perfection, leaving no margin of safety. Now, before we wrap up, to access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community.
Highly recommend it.
To track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store. Disclaimer: all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice.
Right. Definitely do your own research.
Conduct your own due diligence before making investment decisions. If you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
If we connect this to the bigger picture, beyond the balance sheets and the PE ratios, there is one final lingering existential risk that value investors must consider.
Oh, what's that?
It is a question of the physical limits of our universe. Right now, transistors are approaching the size of individual atoms. Moore's law is physically decelerating.
Because things can only get so small.
Exactly. So, What happens to ASML's trillion-dollar valuation dreams if the semiconductor industry permanently pivots away from this planar shrinking?
Yeah.
What if they rely entirely on advanced 3D chiplet packaging to gain performance, stacking older chips like Legos?
Oh, wow.
If the industry permanently reduces the need to buy newer, more expensive lithography machines, what happens to the world's most perfect monopoly then? Something to ponder.
Wow. Just when you think you have a clear picture, the terrain shifts right beneath your feet. A brilliant thought to end on. Thank you for taking this deep dive with us.